Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. This is an interesting investment strategy, especially with a stock market that is going down like a rock, and it could make you money. Quite frankly, I believe in it. Uh, but let me explain the history and then what is happening now. This chart shows in the 1970s what happened in that decade to inflation, which is the red line, okay, and then to interest rates, long-term interest rates, bond yields is the blue line. These areas here denote a recession. And what this chart shows is that during a recession, the red line always comes down. During a recession, the red line always comes down. But notice that also there is another line that comes down, the level of bond yields. They come down, they come down, they come down here, here they come down, and this again, they come down when the inflation declines. So in the 70s, the rule was if inflation declines, bond yields decline. So what happened in most recent history? Here is from 2000 to 2022, current times. Again, these are recessions, and what you see is inflation declines, bond yields decline. 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 So right now, inflation is 9.1%, and bond yields are going up. Now, why do I say this? Because if bond yields decline, then you can make quite a bit of money you buying long-term treasury bonds. But of course, the trick is to have the inflation to decline as well. But let me show you the next chart, which I think is eye-opening chart. The reason I'm talking bonds is because if interest rates on long-term treasury bonds, 10 years or longer, let's say TLT is the ETF, if interest rates decline from, let's say, from 3% to 2.5%, you're probably going to make very close to 10% profit, plus, of course, the yield on TLT. That's why I'm looking at bonds. And in a market that is sagging already 25, 30%, to make 10% because interest rates decline could be an attractive strategy. So let me show you this chart. This chart shows the ratio between this S&P 500 and bonds and bond prices. So what you see here, when the ratio declines, means that bond prices are stronger, are rising relative to the S&P 500. This is the same thing here. Bond, like let's take TLT, is stronger than the market because the ratio, the denominator, is rising faster than the S&P 500. So here is bonds are stronger. Here that is declining because bonds are stronger than the market. Here, look what happened here. Here we are at an interesting peak. So let's look now at this indicator at the bottom page. And when this indicator comes down, this indicator, by the way, measures growth in the economy. When the economy slows down, what happens? Bonds are more attractive than stocks. When the indicator declines, bonds are more attractive than stocks. When the indicator declines, bonds are more attractive than stocks. And look what happens here. So what this crossing means that this curve is likely to go down, especially if we are in a recession. Remember the previous two slides. So what are we talking about? That if we invest in TLT and interest rates go from 3% to 2.5%, TLT is likely going to rise 10%. If short-term rate, if long-term interest rates decline from 3% to 2%, TLT is likely to appreciate 20%. So what this curve is saying is that the time has come, and in fact, in the last several sessions, weeks actually, bonds have started to outperform stocks. Maybe we are entering a favorable period to use this strategy. Of course, the responsibility is yours to decide. Thank you for listening. I hope you enjoyed it. Thank you very much. See you soon. Take care.